What's going on? Alex here, and today I'm answering your tax questions from Reddit. And today's question has to do with solo 401k contributions and how they work for a self-employed individual. Let's take a look. All right, so this question comes from Darth Diablo and goes as follows. First year self-employed, what's the maximum deductible contribution I can put into my retirement accounts? And the hypothetical numbers are as follows. And as we go through this example, I'm actually going to work through a tax return and show you guys how this all plays out and how you can calculate that maximum contribution. So we have gross profits from self-employment of $85,000, and one half of self-employment tax is $6,000, and the net profit from self-employment is then $79,000. And this person already contributed $6,000 to a regular workplace 401k earlier in the year, before I no longer had the job and am now self-employed. Also, both myself and my spouse both contribute to our TIRAs, or traditional IRAs. We're well under the limits to take those deductions. Based on my research, I think a solo 401k is the way to go, but I could be wrong. I'm at a point where I have most of the hypothetical numbers put into the tax software, but need to figure out my maximum deductible contribution for self-employment retirement plan purposes. The goal is to lower my tax bill as much as possible in the area of self-employment retirement accounts, so I'm not really interested in contributing more into our account beyond what's deductible. And if I go with the I-401k, also known as a solo 401k or individual 401k, it is my understanding that I act as both the employer and employee in making contributions. As an employee, since I've contributed about $6,000 already to a regular workplace plan, that would mean I would be able to contribute only about $13,500 into the solo 401k before I max out for the year. That's the $6,000 contribution that was made plus the $13,500. Gives us the $19,500 maximum salary deferral contribution. Then there's the additional employer portion that I can contribute to myself, right? Frankly, I'm lost here. I see 25% of compensation. So is that 25% of the $79,000, or is it 25% of the $79,000 net profit after the contributions are taken into account? Finally, what tax forms will I need to file? Kind of a maze, right? But at the same time, I'd love to clarify this for you. I have to tell you that right from the get-go, you're asking all the right questions, and I could already see that you're pretty astute in this area, so that definitely helps in terms of getting on the same page in terms of all this craziness. So what are we even talking about? When you are self-employed and you have income from self-employment, net income that is, not losses, you generally can contribute to retirement accounts. Now, traditionally, you can choose an IRA, just a plain old IRA account, individual retirement account, to make contributions, and that generally maxes out around $6,000 per individual per tax year. If you want to contribute more and be able to take more of a deduction in the current year, then you may consider another type of retirement account. You can look into simple plans. You can look into SEP plans or self-employed pension plans. You can also consider 401k plans. Now, again, we're not talking about defined benefit plans, things like that. We're talking about defined contribution plans, okay? So in this case, we're just focusing on that. If you want to maximize your deduction, the solo 401k is typically the way to go if you're an individual who's self-employed. You're not running a business with a whole number of employees. With that said, the question then becomes, how does this all work? And as Darth Diablo pointed out astutely, an individual is limited in terms of their annual salary deferral contribution. That's that $19,500 limit that we talked about. So just so you know where all this is coming from, what I did was pulled up the IRS website and I Googled 401k contributions maximum 2020. This is the link I clicked here. You can see it labeled as Retirement Topics 401k and Profit Sharing Plans. And you'll see the deferral limits mapped out here. So you have $19,500 in 2020, $19,000 in 2019. Similarly, you have the maximum contributions being 100% of the participants' compensation, or $57,000. It's the lesser of for 2020 and $56,000 for 2019. So what I did was simply mapped out all these amounts in a nice little spreadsheet, and this gives us the breakdown of 2019 amounts versus 2020. The reason I'm doing that is because the tax software that I'm about to pull up to show you guys a simulated tax return is for 2019. The 2020 software doesn't exist yet, hasn't been released. So we're going to look at it in terms of 2019, then adjust our figures for 2020 so that I can explain how it all works, show you guys the flow of how the tax return looks with all this craziness. Then we could adjust it for 2020. Before we can do that, we want to take into account that this individual has already made $6,000 in salary deferral contributions to a workplace 401k plan. Again, this $19,500 limit applies on a per taxpayer per individual basis. So even if you have 100 401k plans throughout an entire year, the maximum salary deferral contribution is this $19,000 in 2019 or $19,500 in 2020. So immediately we need to adjust our maximum contribution, and that amount is that $6,000. All right, make sure you all can see this. And we make that adjustment in each year. Okay, and we want to know what's left. Okay, so we now know that in 2019 you have 13,000 available salary deferral contributions, and in 2020 it'll be 13,500. That leaves us with the maximum profit sharing contributions here. Okay, so we still have those maximums that are applicable, and let's go to a tax return. So firstly, we want to make sure that we actually have income to calculate these self-employed deductions, because we don't have any income at the moment, so we're not going to be able to make retirement plan contributions based on that lack of income. So let's pull up Schedule C. Let's put in $500,000 of income. All right. So now we have income from self-employment. We can play around with the retirement plan contributions. Now let's take a look at Schedule 1 just for a second and see what's happening there before we do anything with the retirement plans. Firstly, we have the business income coming from Schedule C, $500,000, makes sense. Then we have the deductible part of self-employment tax that's coming from Schedule SE. So on Schedule SE, we essentially have the net income coming from Schedule C and also the deduction for self-employment taxes, because as a self-employed individual, you're both the employer and the employee. And just as when you're working as an employee and the employer is making payments of Social Security, Medicare taxes on your behalf, they're paying the employer portions, they're getting a deduction for that on their business tax returns. Because you're functioning as both the employer and the employee, you're also getting a deduction for 1/2 or the employer portion of those self-employment taxes, being Social Security and Medicare, that you're paying throughout the year. And that's where this $14,935 comes from. It's 1/2 or 50% of $29,870. All right, so that is the amount we're seeing here on Schedule 1 on line 14, deductible part of self-employment tax. So we haven't done anything with retirement plans just yet. And keep in mind that this software is 2019. We're going to adjust these amounts for 2020. The 2020 software doesn't exist yet, so let's understand it this way, and then we'll adjust it for the next tax year. So we have the income in place. Let's go over to adjustments to income, because all of these retirement plan contributions, they're going to be accounted for separately from Schedule C, separately from Schedule SE. All right. So we need to take that into account, and we'll see those as adjustments to arrive at AGI, or adjusted gross income. Separate place on the tax return. Don't take your retirement plan contributions on Schedule C. All right. I've seen that before. It's improper. It's going to result in an inaccurate tax calculation. Let's keep it simple for now, and let's just assume that this individual made IRA contributions. Married filing joint isn't going to change too much here. I just don't want to complicate this by introducing too many variables. So we are maxing out our IRA contributions. So let's just take a look at that. Make sure that's happening over on Schedule 1, and here it is, $6,000 maximum deduction. All right. And on top of that, let's take a look at some other factors. Now, the IRA contribution may change once we put in the 401k contributions, because if you're covered by an employer plan, your ability to deduct IRA contributions is dependent on your income. So if our income is $500,000 and we have this IRA contribution maxed out at $6,000, this deduction may very well disappear once we factor in the 401k plan contributions, and we'll see how that factors in a second. All right, so we're talking about the employer portion of the 401k plan contributions, and you can see that the profit sharing portion is 25%. So for self-employed individuals, it actually comes out to be 20%. There's a bit of a complication how that's calculated, but at the end of the day, you're not going to see 25% as a self-employed individual. You're going to see 20% as that calculation for the employer portion or the profit-sharing portion of the 401k plan contribution in a particular year. And as we move down here, we also want to max out the salary deferral contributions, but let's remember that we already made $6,000 in contributions to another plan. So we want to make sure that that salary deferral contribution for 2019 would be the $13,000, not the $19,000, because we want to avoid making excess contributions. Let's take a look at how the return is shaping up. So on Form 1040, we have the adjustments to income being quite a bit more than they just were. So let's take a look at Schedule 1. We have the deductible part of self-employment tax as the $14,935, but now we have the self-employed SEP simple and qualified plan deduction of $56,000. Now let's remember that the maximum for tax year 2019 was $56,000, so that's what's going on here. So there is a worksheet for all of this goodness that shows us all of the various calculations. I'm not going to go through this super in depth right now, but just understand that the plan contribution rate was 0.25, which is the 25%. And then the rate in line 1 plus 1, you do some division here, you end up at the 20%. So that's how that's happening in very rough terms. And at the end of the day, we have the maximum of $56,000. We have the contribution of the salary deferral of $13,000, allowable elective deferrals. And that allows us to back into the profit sharing amount of $37,000 for the year. That's essentially how all of this functions. Now, we will see that the IRA deduction, as promised, did disappear off of the return. The issue is that we exceeded the maximum income at which you can still deduct IRA contributions if you're covered by an employer plan. Let's decrease the income and see what effect that has. And these limits change every year. The IRS website breaks it out pretty clearly here. So if your filing status is single, we're assuming single for now, just keep it simple, and your modified AGI, there's a whole calculation that goes along with that, is 74,000 or more, then you can take no deduction here, basically. So that's the whole idea with regard to the IRA contribution. This is if you're covered by a retirement plan at work. Now, let's see if we can reverse engineer this to where you can both make the maximum 401k plan contribution and also get the full IRA deduction. So in this case, the modified AGI is 64,000 or less. Let's go ahead and reduce this income to 70,000. All right. And we should still be able to maximize the 401k plan contributions and also get that IRA deduction given that our income is below the threshold. Let's take a look. All right, so modified AGI, I'm not going to go into the particular details about how that's calculated, but at the end of the day, we have other income, $70,000. This is coming from Schedule C, and let's see what's happening. So, perfect. We have the self-employed contributions of $26,011. Let's see what's happening there. Based on the fact that our income is now less, that maximum contribution is also less. Again, we have to factor in that 20%. But we do get the IRA deduction. All right, so you can see how there's a lot of moving pieces here, and you want to make sure that if you have the goal of making a deductible IRA contribution, then you have to make sure you don't exceed the maximum allowed thresholds for that. Otherwise, you're going to end up making a non-deductible contribution, if anything. All right, that is how this all functions in terms of the tax return. So you could see that you have both the employer portion and the employee portion to factor in, and also the fact that these limits apply on a per employee basis, where these limitations apply on a per employer basis. So you can have a situation where you're contributing to 5 different 401k plans in a year. This limit would apply once per taxpayer. So you'd only be able to defer $19,000 or $19,500 per individual, but you can have 5 different contributions in terms of the profit sharing side of $37,000 or $37,500 per individual. Okay, so salary deferral applies on an employee basis. Profit sharing applies on an employer basis, all right? We've taken a look at 2019. These are essentially the amounts that are applicable there. The only things that changed for 2020 are that the maximum allowed salary deferral contribution increases by $500 to $19,500, so that salary deferral contribution, instead of $13,000, it instead would be $13,500. All right, so we have the $13,000 here. Allowable elective deferrals would be the $13,500 based on the fact that we already contributed $6,000 to the other plan. The real maximums are the $19,000, $19,500 for those 2 tax years, respectively. Finally, the maximum profit sharing contribution was also increased by $500. So you have these $56,000 and $57,000 limits. So essentially, instead of these amounts for 2019, you'd be looking at these amounts here for 2020 based on the fact that the limits change quite simply. Let's go back to the question and make sure that we absolutely hit it out of the park in terms of addressing all these different issues. So the assumption here was that I can contribute only about $13,500 into my individual 401k before I max out for the year. What do we have? We have the $13,500 remaining deductible salary deferral contribution. So you're right on there. Good stuff. And then there's the additional employer portion. So essentially, is it 25% of the $79,000 figure, or is it 25% of the $79,000? So this calculation is a bit involved. Your tax software should do a lot of the heavy lifting for you, but at the end of the day, you want to make sure that you factor in the salary deferral contributions and you still respect the limit for a particular tax year so you don't make excess contributions. Finally, Darth Diablo asks, where exactly in the tax forms would I report the employee and employer portions of the solo 1K contributions? I'm assuming these figures will go into 2 distinct tax forms. Now, a lot of the magic that is happening on your tax return has to do with the solo 401k, and that's going to happen on Schedule 1, as we saw, because you are indeed the employee and employer in this scenario. And appreciate the help I can get navigating through this maze I'm in right now. Hopefully, Darth Diablo, we have shown you the light at the end of the maze and clarified some of this stuff for you. If you enjoyed this video, feel free to leave a comment below, like the video, subscribe to the channel, share the video, and drop some questions in there because I love answering your guys' questions. And now I'm getting more and more in the comments there that I'm able to address in video. So it's a beautiful thing. It's a cycle of goodness that I'm happy to be a part of. All right. Hopefully this was helpful for you. Thanks for watching.